Welcome back to the Canadian Real Estate and Mortgage channel. Before we get into today's video, please consider liking, subscribing, and leaving a comment as it helps push our content forward in the algorithm. Now, without further ado, let's get into today's topic, choosing the mortgage that is right for you. Very briefly, let's go over what a mortgage is. If you want a more detailed video on what a mortgage is and what it entails, check out our video in our mortgage playlist. A mortgage is when you buy a home where you're only able to pay for part of the purchase price. The part that you pay is the down payment. To cover the remaining cost of the purchase, you may get help from a lender, and you slowly pay back the mortgage over a certain period of time. Now, when considering a mortgage, you have a lot of things to consider. When you shop for a mortgage, your lender or mortgage broker provides you with a lot of options. Make sure that you understand the options and their features. This will help you choose the mortgage that best suits your needs. This includes the mortgage principal amount, the amortization period, which is the amount of time you have to repay your loan, and the payment frequency, which is how often you'll be making mortgage payments. Let's take some time to talk about term. The mortgage term is the length of your mortgage contract. This consists of everything in your mortgage contract, including the interest rate. Terms can range from just a few months to 5 years or longer. At the end of each term, you must renew your mortgage. If you can't pay the remaining balance in full, you will most likely require multiple terms to repay your mortgage. The length of your mortgage term has an impact on your interest rate and the type of interest you can get, either fixed or variable. The penalties you have to pay if you break your mortgage contract before the end of your term, and how soon you have to renew your mortgage agreement. So how is your mortgage amount calculated? So the amount you borrow from a lender for the purchase of a home is the principal amount. This usually includes the purchase price of the home minus your down payment, and mortgage loan insurance if your down payment is less than 20%. To find out more about mortgage loan insurance, check out our video on down payments. Now, how is your mortgage calculated? Mortgage lenders use factors to determine your regular payment amount. When you make a mortgage payment, your money goes towards the interest and principal. The principal is the amount you borrow from the lender to cover the cost of your home purchase. The interest is the fee you pay to the lender for the loan. If you agreed to optional mortgage insurance, the lender adds the insurance charges to your mortgage payment. Circle back to the amortization period. It's the length of time that it takes you to pay off a mortgage in full. The longer the amortization period, the lower your payments will be. But there is a catch, and that is the longer you take to pay your mortgage off in full, the more interest you will pay. If your down payment is less than 20% of the purchase price of your home, the longest amortization period you're allowed is 25 years. Let's talk about interest rates now. They've been all over the news cycle as the Bank of Canada has been raising them to try to combat inflation. But in this context, the interest rate is the fee that you pay to the lender for borrowing money. The higher your interest rate, the higher your mortgage payments will be. Every time you renew your mortgage term, you renegotiate your mortgage interest rate. This means your mortgage payments can be higher or lower in the future. So, when you apply for a mortgage, your lender offers you an interest rate. You can negotiate this rate to see if you can lower it to get a better deal. The interest rate your lender offers you may depend on the length of your mortgage term, the type of interest you choose, the current posted interest rate offered by your lender, your credit history, if you're self-employed, if you qualified for a discounted interest rate, the type of lender you choose like a bank, a credit union, financing company, or mortgage investment company, and the specific lender. Before you commit to a lender, shop around to get the best rate for you. This could end up saving you tens of thousands of dollars. But wait, it gets a little more complicated than that because there are different types of interests that your lender can offer you. Starting off with fixed interest rates. Fixed interest rates stay the same for the entirety of your term, but they do tend to be a bit more expensive than variable rates. However, they do tend to be the safer option in case interest rates do go up, but you miss out on the benefit if interest rates do go down. Then we have variable interest rates. Variable interest rates can increase and decrease during the term. Typically, the interest rate is lower with a variable interest rate than a fixed interest rate. With a variable interest rate, you can keep your payments the same for a duration of your term. Lenders can call this a fixed payment with a variable interest rate. You also have the option to opt for an adjustable payment with a variable rate. With adjustable payments, the amount of your payment will change if the rate changes. There is one more type of interest rate that not everyone offers. It's a hybrid or combination interest rate. This has both fixed and variable interest rates. Part of your mortgage has a fixed rate and the other has a variable interest rate. The fixed portion gives you partial protection in case interest rates go up. The variable portion provides partial benefits if rates tend to fall. Each portion may have different terms. This means hybrid mortgages may be harder to transfer to another lender. Payment frequency. This refers to how often you make your mortgage payments. You can choose an accelerated payment schedule. Accelerated payments allow you to make the equivalent of one extra monthly payment each year. This can save you thousands or even tens of thousands of dollars in interest over the life of your mortgage. Your payment frequency options include monthly, semi-monthly, bi-weekly, weekly, accelerated bi-weekly, or accelerated weekly options. Finally, the last part of your mortgage payments will be your property taxes. As a homeowner, you have to pay property taxes on your home. The amount you pay depends on the value of your home and where you live. Some financial institutions collect and pay your property taxes for you. This may be a condition of financing. If that is the case, your lender adds the property tax amount to your regular payments. And that's all we have for today's video. If you enjoyed it, please like the video, consider subscribing, and share it with all your friends who might find this information useful. That's all for now. Take care.